Hi, today we're going to talk about job costs. So we'll be looking at different ways to manage our business. So if you're a manager, you probably have a product or service that you're doing, and we're going to look at different ways that typically happens. So our first way to look at things is called job cost, and it's important to keep track of our jobs, of course. We could use process costs, standard costs, or activity costs, and we'll be talking about all of those in the future. So job cost is typically used when we produce products that are not alike. We call them heterogeneous. So we use that with buildings, ships, car repairs, lawyers' clients, hospital clients, accountants' clients, airlines, all kinds of fun stuff. Many of these could take a really long time to finish. Okay? If our products are all alike, just think of a zillion Hershey Kisses getting produced every hour. We'd probably use something like process costs to manage those. So things like milk, soup, cement, gas, typical ways. Hershey Kisses, I'm not sure what Hershey does. Those could all be, every product is pretty much like every other product. So we're going to use an average cost to manage our costs. Okay? In job costs, clients typically come to us with different needs or that they want, what they want us to do for them. So their products are different. Each client probably different. Okay? Issues. We got some special issues here. We'll probably have to bid on the work. So we have to calculate an estimate of the cost before we can bid. We have to submit it. Don't forget, we need to put in direct labor, direct material, overhead for each job. We're probably going to assign a number or code for each job. We may print out a magnetic card to help track all the labor and material that we buy for this particular project. And cost and revenues, typically, they can vary from our estimates. So we might, make a lot of money or not make any money at all. We have some special issues. We need to calculate an overhead rate, possibly more than one overhead rate. We could have more than one department involved. And we estimate the overhead rate way before we do the job. We probably do it before the year starts. So we take our estimated overhead dollars divided by some activity. It could be labor hours, labor dollars, machine hours, square footage, energy usage, anything, whatever we think drives the cost or most of the cost for overhead. And we need to calculate the cost of each job to see if it's profitable and to see how we estimated the cost. Okay? And we need to assign each job to some account, either in the balance sheet or the income statement at the end of the month. If the job is still going on, the cost will go to work in process. If it's finished but not sold, we haven't recorded revenue, the cost would belong in finished goods. If the job has been sold, the cost belongs in cost of goods sold. Okay? And finally, the end of the year, we need to adjust our overhead accounts to actual. So we can only publish our actual cost as overhead on our financial statements. What we would do is look at the actual amount of overhead that we sustained during the year, okay? And we'd subtract the amount of overhead that we applied. If we applied too much, we're over-applied. If we applied too little, we're under-applied. And we typically adjust our cost of goods sold at the end of the year. So if we are over-applied, we debit our overhead account, credit cost of goods sold for the difference. We're under-applied, we debit cost of goods sold and credit overhead for the difference. And that's the end.